Hi, friends. If there's one strategy in financial planning that tends to be consistently underappreciated, it's the Roth conversion. At first glance, it can feel a little counterintuitive. You're voluntarily choosing to pay taxes today when most people are trying to defer them. But when you step back and look at the bigger picture, Roth conversions can be incredibly powerful. For many families, taxes are one of the largest expenses they'll face over their lifetime. And unlike markets, taxes are something we can often plan around. A Roth conversion is simply moving money from a pre-tax account, like a traditional IRA, into a Roth IRA. You pay taxes on the amount converted today. But from that point forward, the money grows tax-free and can then be withdrawn tax-free in the future. There are a few key benefits that are worth highlighting. First, it gives you more control over your lifetime tax bill. Instead of being forced to take larger required minimum distributions later in life, often at higher tax rates, you can be more intentional about when you recognize income and at what rate. Second, it can create meaningful amounts of tax-free growth over time. If you have a long time horizon, or even a moderate one, that tax-free compounding can really add up and provide flexibility down the road. Third, Roth accounts can be very effective tools for estate planning. For many families, leaving behind tax-free assets to the next generation can be far more valuable than passing along pre-tax dollars that come with a future tax liability. And finally, it gives you flexibility in retirement. Having a mix of taxable, tax-deferred, and tax-free assets allows you to be much more strategic with withdrawals and better manage your tax situation year to year. Now, Roth conversions aren't right for everyone, and timing matters a lot. It often makes the most sense in years when your income is temporarily lower or before required minimum distributions begin. But when used thoughtfully, it's one of the most effective ways to turn future tax uncertainty into something much more manageable. So as you think about your own plan, it's worth asking not just how much you're saving, but where you're saving and what that means from a tax perspective over time. As always, thoughtful planning isn't just about reacting to what's happening today. It's about positioning yourself for the best possible outcome over the long term. Thank you, and I look forward to talking with you next Friday morning.